Okay, so we are beginning with the FRM Part 2 curriculum. FRM Part 2 is always considered to be a much more exotic, that is difficult stuff from an understanding point of view. There are more or less models and models and models which are mathematically derived. As you know, we are concerned not with the derivation of the model, but with the conclusions, the limitations and the intuition behind the same. So we will use a number of techniques as in numbers, comparisons, okay, sometimes stupid, sometimes whatever, to ensure that complicated stuff gets easier for us to retain and digest. If it so happens that in future you tend to get into an enterprise wherein you are handling these models, or you are doing some hedge fund strategies, or you are doing some risk management strategy in some banks, which is not ruled out, this is possible. In that case, there you will actually understand these models in entirety. Let me also point out that in actuaries, okay, people who do actuaries, they do all of this in a mathematical sense, as in they derive each and every stuff. They are less concerned with the intuition of it, but they are more concerned with the derivation of it. And here we are concerned with the intuition and less with the derivation. So let me acknowledge that there could be 5% or 10% stuff in FRM Part 2, which one has to accept, manna padega, which one cannot derive. There's a property, that property cannot be derived, we have to just accept it. Because if we were to derive the property, it will take us to actuarial science. Okay? So we got to be very realistic in terms of the fact that number one, we got to fare very well in the exam, and number two, we got to retain the stuff for the long term. So the teaching should be designed in such a manner that you retain it for the long term. We cannot do a lot of Excel calculations in class because that totally diverts the class into something else. But the way in which I explain, I definitely give you a gist of if you were to go home and practice the same thing on Excel, how can you do the same? So in case you have an urge, you can try, you can Google the same, or you can try on Excel yourself. Okay, obviously some of it might seem to be super a bit hazy right now because we have to actually got to do all that stuff to be confident. Now, if you look at the curriculum, we have the three main pillars: market risk, credit risk, operational risk. Market risk, credit risk, operational risk. You know, market risk deals with the risk associated with interest rate, exchange rate, etc. The movement in prices. Credit risk deals with lending risk. The bank is lending, so the customer can default. Or counterparty credit risk that we have in derivatives. When we are entering into an over-the-counter derivative, the other party can default. No. Operational and integrated risk are totally new. They refer to the fact that in an organization, internal processes, internal systems, okay, they can fail to function properly. There could be a fraud by some employee. Okay, all those are operational risk. The fourth topic is risk management and investment management. It deals with a lot of portfolio stuff. Okay, portfolio stuff, advanced levels of portfolio management. And the last is current issues in financial markets. Now this is really good because I think even in the other curriculums, say CFA and all that, current issues should always be there. So that when students are taking the exam, at least at that time, they are aware of what has happened, okay, recently in the context of our curriculum. So they have taken up a number of current issues in financial markets in the last section, which is 10% of the curriculum. Okay. So you can see 25, 25, 25, the first three pillars, 75%, and then 15% portfolio stuff and 10% current issues. Okay. Now, we are going to start the class with market risk. Okay. I will be starting with market risk, and Vivek sir will be taking classes on current issues. Okay. Parallelly, these two topics will go on. Once they are over, then we will take up the other two topics and then the last one. Okay. Market risk is the more mathematical one. Okay. Let us understand the risk which has been most researched and most quantified is which risk? Market risk. Okay. A lot of research has taken place. In FRM Part 1, there is a lot of market risk stuff in the nature of war, value at risk, which we may not have done till now, but yes, we will do it in the course of time. Now, in the market risk, we have several topics. I deliberately thought to start with the last chapter of market risk. There are 17 chapters, and the last chapter of market risk is dealing with options, and this chapter is taken from Hull. Okay, it would be difficult, challenging, but easy to prepare. This is Volatility Smiles. Okay, so this chapter is connected to options. Every other thing of options, we have it in part 1, and a single chapter on options, Volatility Smiles, is devoted into part 2. Okay. Now, before I begin this chapter, let's understand that even though FRM part 2 is exotic, the general level of preparation across the globe is lacking. And because it is lacking, if we are very dedicated in the classes, in that case, we will find that our performance will be far exceeding the rest of the world. So in absolute terms, there cannot be 10 upon 10 satisfaction. There would be spaces wherein you have to accept things. But in relative terms, the satisfaction level would be very, very high. Okay, so from a paper attempt point of view, you will be very confident of clearing FRM part 2 as a result of diligent and regular classes that we have. Okay, Volatility Smiles. Now let me discuss what is the chapter talking about. There would be a parallel write-up along with the pre-printed notes. So either you got to have your copy in which you can write, or you have to use the space that is provided. Copy would be best. I would advise if you are carrying a copy. Okay. Volatility Smiles. Now what is the background of this topic? Let us discuss. Draw it with me, please. On the x-axis, we have time. And on the y-axis, we have stock price, S. So on the x-axis, I have taken time, and on the y-axis, I have taken the stock price, that is what, S. We have a call option on this stock. Call option on this stock at a strike price which is K. At a strike price which is what? K. Now let me mark that K over here. I am doing the marking. Please mark with me, this is K. So K is the exercise price. Some people have the habit of denoting the exercise price by E. Some people have the habit of denoting the exercise price by X. Hull has used the notation K. I am trying to be disciplined regarding the use of the notation. So K is the exercise price. Now we are all aware that call option will be exercised if the stock price on maturity exceeds what? K. Okay. Now I am marking the maturity over here. Okay, please keep on marking along with me. Don't wait for any proper dictation, because then we tend to lose out a lot of time. This is the maturity T. Here is where the option matures. Okay. I am assuming it's an European option. What option? European option. Right now the stock price. Right now the stock price is S0. Mark over here. The stock price is S0. S0. So right now the call is in the money or at the money or out of the money? Out of the money. Right now the stock price is less than K. Now in this period, let's call it 3 months, the T is 3 months. In this period the stock can take infinite number of paths. Infinite number of paths. These paths could be shown like this. I am showing the paths. Stock lands up over here. Please show the path. The stock lands up over here. If the stock lands up over here, you find that the payoff from the call will be what? S minus K. Payoff will be what? S minus K. You can call these prices on the blue line as ST. What? Don't write it, just understand, because we just don't want to fill up the entire thing with notations. ST on maturity, S0 today. So if the price is ST on maturity, the payoff from the call option will be ST minus K. This is just one path. Let me draw another path. I am drawing another path over here. Okay. The second path, the call lapses. ST is less than K, so payoff will be equal to what? 0. One more path. Call exercised. So we'll be doing simulation in part 1 as well as part 2, both the parts. Simulation technique is a technique which is able to simulate how the actual stock price in the market behaves. And there are infinite number of paths, out of which 10,000 or 20,000 simulations could be easily done on the model. So when I said FRM is number 1 exotic, number 2 illusory, it is an illusion because are we able to exactly plot the 10,000 paths over here? No. But we are imagining that, okay sir, what you are saying could be understood. So many a times this limitation would happen in class. You have to imagine things, okay? And of course there are ways to do those things on the Excel or on other softwares at home, which I will indicate from time to time. But then that urge has to depend upon you, whether you want to do it or not. For the purpose of exam, with the help of the explanation that is given and attempt of questions, we can do it all, okay? But for the purpose of making it concrete, you require to do it at home on the Excel or different models. So we have a call option situation over here. We say that the payoff from a call option is equal to S minus K, comma 0, whichever is higher. Whichever is higher. Now please imagine that we are running a simulation and the simulation is carrying out different paths. K over here is suppose $100. So the first path leads us to $130. So the payoff is equal to what? 30. The second path, the green one, takes us to $90. So payoff is what? 0. The black path takes us say to 110. So payoff is what? 10. So 30, 0, 10 and so on. Different values. Now these values have a probability distribution. The stock price on maturity has a probability distribution. According to the Black-Scholes model. Which model? Black-Scholes model. The stock price on maturity is log normally distributed. What distributed? Log normally distributed. You know the meaning of it? It means that the ln of the stock price, what? Natural log of the stock price follows normal distribution. Stock price is log normally distributed, which means that the natural log of the stock price, ln S, follows what distribution? Normal distribution. Okay. Just to show it in a different slide, you can also show it below in a different diagram. We are still not complete with the diagram, I'll come back to it. But once I want to show it to you, the log normal and normal distribution. Please draw. Draw this diagram. So on the x-axis of the upper panel, I am having S. On the x-axis of the lower panel, I am having ln S. ln S, okay, natural log of S, log S to the base E. On the y-axis throughout we have probability. The log normal distribution is of this shape. The log normal distribution is of this shape. Please draw it. Okay, positive skewed. The log normal distribution is of this shape, positively skewed. People actually believe in this. Why? Because a stock price cannot go below 0. Stock price cannot go below 0. So it's bounded on the left by what? 0. And on the right side you will find that extreme values are there, because बढ़ने को stock price उल्टा पुल्टा बढ़ ही सकता है. So it's positively skewed. Now you remember lottery, positively skewed. Okay. And when you take the natural log of this, the natural log of this corresponds to a normal distribution. A normal distribution, which means this sort of a diagram. Okay. My diagram would not be very clear, okay, but you can understand that I wanted to draw a normal distribution. So ln S is normally distributed, and therefore S is log normally distributed. ln S is normally distributed, which means S is log normally distributed. Okay. Please write that to the side of this, wherever you have a space on the right side. Please write that. Log normal distribution. Write the word log normal distribution. Okay. log normal distribution. Log normal distribution. Okay, log normal distribution. Coming back to the first diagram. Okay, I think I've lost my diagram only. Take whatever. So, Black-Scholes model is of the assumption that the stock price on maturity, is log normally distributed. Okay. The equation of the Black-Scholes model is like this. Right on BSM, Black-Scholes model. The equation is C0 equal to S0 and D1 minus K into e power minus RT and D2. And D2. This is the equation of the Black-Scholes model, and we'd give a lot of time to it at level 1, where we tell the student that obviously we are responsible for understanding how this equation is derived, but every time rather than the maths try to feel the equation. The equation is saying that call value is equal to S minus K. Call value is equal to S minus K. However, since it's a European call, the European call can be exercised at any time or only on maturity? Only on maturity. So we should take K or the present value of K. Present value of K, because you have the right to buy the share at K after 3 months. So today from the stock price, how can you deduct the 3-month baad ka strike price? You should deduct the present value of. So can you see the basic equation ka tone? Okay, I'm just showing it to you, but I can't dictate all this. Is that call option value is S0 minus present value of what? K. Are you able to understand this? Present value of K is K divided by e power RT, which could be written as K into e power minus RT. Correct? Now, in this equation, what is missing is the volatility premium or time value. What is written on the board is the intrinsic value, the minimum value of the call, S minus PV of E. But the call should trade at a higher value because of what? Time value. So in order to incorporate time value, we have two probabilities inserted in this equation. The probabilities are coming from log normal distribution. They are ND1 and ND2. They are ND1 and ND2. Okay, those are the two probabilities coming from here. So when we have C0 equal to S0 into ND1 minus K into e power RT ND2. What is ND1, ND2? They are probabilities, which means ND1 is the delta of the call. What is it? Delta of the call, which means if the stock price goes up by 1, the call will go up by how much? All of you must be knowing the basics of derivative. If you carry out a derivative of call option with respect to stock price, DC by DS, partial derivative, keeping other factors constant, won't you get ND1? Can you see the equation? If C0 is taken as Y, what? Y. ND1 is taken as 0.4. So we have Y is equal to 0.4x. So what is the derivative of 0.4x? 0.4. Okay. So can you see DC by DS0 is equal to what? ND1. ND1 is 0.4, means one call is equivalent to 0.4 shares. One call is equivalent to how many shares? 0.4 shares. One call is equivalent to 0.4 shares. I am going very slow. I have not started the chapter because I know if I go fast, many people will not follow anything at all. It may be challenging, but I am trying to make it as slow as possible. If somebody buys a stock, he is bullish or bearish? Bullish. If somebody buys a call option, is bullish or bearish? Bullish. So buying the stock and buying a call are substitutes. Buying the stock and buying a call are what? Substitutes. But they are not perfect substitutes. Because if you buy the stock, if the stock price goes up by 1, call will not go up by 1. Call will go up by 0.4, 0.6, 0.7. So one call is not equivalent to one share. It is equivalent to partial share. That partial is ND1. ND1 is the delta of the call. While ND2 is the probability that the call will be exercised on maturity. ND2 is the probability that the call will be exercised on maturity. I have lost the graph in my slide, but you have it in your copy. The first graph that you have drawn, can you see in the two paths stock price was more than K? And in one path, I think the green one, the stock price was below K. 2 times the stock price was above K and 1 time the stock price was below K. So what is the probability that the call will be exercised on maturity? That probability is ND2. What is it? ND2. Suppose 30%. So if the call is exercised, then we have to pay K. Call ka bookish definition kya hai? Right to buy. So you will buy the share on maturity at K only if the call is exercised. So then you have to pay K, so it's minus K. And you'll get what? S. So the tone is call is equal to 0.4 shares minus present value of what we have to pay, K, into probability that we have to pay that. ND2 is the probability that we have to pay that. Okay, this is the background of Black-Scholes model going on. If you have copied all this, have you copied? Okay, you are copying. You may please write down by arrows the meaning of ND1 and ND2. ND1 means delta of call. ND1 means delta of call. ND2 is the probability that the call will be exercised. Probability that the call will be exercised. Probability that the call will be exercised. Call will be exercised. Next line, both ND1 and ND2, both ND1 and ND2 are cumulative probabilities from the normal distribution. Cumulative probabilities from the normal distribution of LNS. Cumulative probability from the normal distribution of LNS. Cumulative probability from the normal distribution of LNS. Cumulative probability from the normal distribution of LNS. Okay. Now, I am not writing over here the formulas of D1 and D2, they are of no use, but please understand D1 and D2 depend upon volatility. Depend upon what? Volatility. So ultimately C0 equal to, please write down, function of, this all of you know, even level 1 students part 1 and even CA students. Call option is a function of S K, R, T, sigma and dividend. Call option is a function of S0, K, R, T, sigma and dividend. Is it okay with you all? Can you tell me the relation between call and stock? Positive. Between call and K? Strike price if it is higher. It's a good call or a bad call? Bad? Higher exercise price, right to buy at a higher K, that's bad, no? So higher the K, lower the call, higher the interest rate, higher the call, because call is a substitute of buying the stock, and if you buy the stock, you have to pay the whole money. In the call, you just have to pay what? Premium, so you enjoy leverage. Anybody who enjoys leverage loves higher interest rate. Okay? Volatility, any option is a positive function of what? Volatility and what? Dividend. Call is a negative function of dividend, because if you buy a call, you lose dividend. If you buy a stock, you will gain dividend. Okay? So this is the relationship between all of them. Let us mark the nature of relationship. Plus, minus, plus, 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 minus. These are all part 1 stuff. I have not even started the chapter. Because what do? If I start, you will not understand a single word of it. So I'm trying to take you over there so that at least I can start the chapter. Okay? Now, if we ignore dividend, which means I'm rubbing out dividend, you can put a circle on dividend and then cross it, just for remembering what was Sir saying. Now, these are the 5 factors that influenced option. Out of these 5 factors, which are the factors which are known in real life with certainty? Let's talk about it. I want to find out the price of a call option in real life. Stock price, is it known? Yes. Bazaar mein chal raha hai. Exercise price, it's fixed. Rate of interest, although one can dispute about it, sir, which rate of interest, it keeps on changing this or that, but still, risk-free rate of interest we can take from treasury securities. It is doubtable, but not a very, very big thing. Time, can you count? Yes. If 3 months are left, 3 months. So I mean to say, S0, K, R, and T are known with certainty, But sigma means the volatility of the stock during the life of the option. The volatility of the stock during the life of the option. माने option में 3 महीना बाकी है तो 3 महीने में stock कितना volatile होगा? Daily 5% volatile होगा कि 2% volatile होगा? Is it known? Stock कितना volatile होगा आने वाले period में? Is it known? No. So I mean to say, Black-Scholes model is considered to be a great model and elegant model because 4 out of the 5 inputs are known with certainty. 4 out of the 5 inputs are known with certainty. What are the 4 inputs? Stock price, strike price, interest rate, and time. What is the input which is not known? Volatility. That is not known. Traders do what? Just as I'm diverting, 2 minutes I'm diverting. Nobody in the bond market talks about the fact that bond price is trading at $964.2. Nobody says this, only we say this in class. The world says that bond price is right now trading to yield 11%. Bond price is right now trading to yield 11%. People talk about the yield implied by the bond price, YTM. Nobody talks about the price in absolute terms. Because if people talk about the price in absolute terms, will they be able to compare bonds of different prices? No. One bond has a face value of 1000, it is trading at 964. One bond has a face value of 100, it is trading at 102. One bond has a face value of 1 lakh, it is trading at 99,645. Can you compare these prices? No. But can you compare the yields? Yes. So bond market may we calculate YTM. What is YTM? It is the yield implied by the current bond price. It is the yield implied by the current bond price. Same way, traders, the world does not talk about the price of call option as $4.5 or $7.2. Instead, they do what? They put the call option price on the left hand side. Call option का price बाजार में चल रहा है. They put it on the left hand side and they back calculate sigma. They put the option price on the left hand side and they back calculate sigma by a complicated trial and error reverse engineering process. Okay. That sigma is called implied volatility. What volatility? Implied volatility. Look at the word implied. Sir, the volatility which I have not estimated. I was wanting to know what is the volatility of the stock in the minds of the people. Stock कितना volatile होने वाला है, लोगों को भी तो कुछ लग रहा होगा. उनके mind में क्या volatility छिपा हुआ है. तो उसके लिए मैंने समझा कि ऑप्शन का जो प्राइस चल रहा है, द प्राइस ऑफ द ऑप्शन, हु हैज डिटरमाइंड दिस प्राइस? द वर्ल्ड by the forces of demand and supply. So if I put the option price on the LHS and calculate the sigma from the RHS, reverse engineering, we call it implied volatility. What volatility? Implied volatility. So look at the language. 3-month call option on Nifty. 3-month call option on Nifty at a strike price of 7,500. It's presently trading at 19% vol. Is presently trading at 19% vol. Is presently trading at कितना रुपया नहीं बोला? Sir, it is trading at a price which reflects a volatility of what? 19%. Okay. After 1 minute, the price of the option goes up. whereas stock price is same, Nifty उसी दाम पे trade हो रहे हैं. Just one moment has passed, so we can say time is also same, rate of interest is same, everything is same, but option price has gone up, and now the implied volatility is 20.25%. So it means, sir, just now the estimate of the market of the world regarding the volatility of the stock has gone up to 20.25%. Options are traded in vols, they are not traded in rupee. People speak about options in terms of volatility. Okay? So the price of the option is 42% vols, 28% vols. So there are sophisticated software which can put the option price on the LHS and calculate volatility in instant. We can't do it on pen and paper, but they can do it on pen, in a moment. That's called implied volatility. The entire chapter is talking about implied volatility. Is there a single LOS on implied volatility over here? No. Implied volatility is a part 1 topic. What topic? Part 1. Okay? Implied volatility is the volatility implied by the option price. There is no way by which you can say that sir समझ में नहीं आया, क्योंकि अगर ये समझ में नहीं आया तो फिर कुछ समझ में नहीं आएगा. ठीक है तो? And I think the best advice is thinking about YTM. That's the best support. कि बॉन्ड का प्राइस जो रहता है उसके हेल्प से YTM निकालते हैं. 2 मिनट बाद if the bond price goes up, the yield becomes lower. The bond price goes down, yield becomes higher. Okay, there's an inverse relation, but here option price and volatility mein there is a direct relation, we all know. So if the option price goes up in rupee terms, volatility is what? Higher. Okay, implied volatility. This chapter is about implied volatility. Okay, so please write down after this equation that you have on the board. BSM is an elegant model. BSM is an elegant model. BSM is an elegant model. BSM is an elegant model as 4 out of the 5 inputs. 4 out of the 5 inputs in BSM are known with certainty. 4 out of the 5 inputs in BSM are known with certainty. 4 out of the 5 inputs in BSM are known with certainty. Full stop. The only input not known, the only input not known, the only input not known is sigma. It's sigma. Full stop. Para change. How do traders use BSM then? How do traders use BSM then? How do traders use BSM then? Question mark. ट्रेडर्स लोग बीएसएम कैसे यूज करते हैं? नेक्स्ट लाइन. ट्रेडर्स use the current option price on the LHS. Traders use the current option price on the LHS and 4 inputs on the RHS. Traders use the current option price on the LHS and 4 inputs on the RHS. 4 inputs on the RHS to reverse engineer and back out sigma. 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 Full stop. This sigma is known as IV, implied volatility. This sigma is known as implied volatility, IV. IV. Full stop. So option prices are stated in terms of vols. So option prices are stated in terms of vols rather than in terms of dollars. Option prices are stated in terms of vols rather than in terms of dollars. Option prices are stated in terms of vols rather than in terms of dollars. In terms of dollars. Full stop. Para change. Assumptions of BSM. Para change. Assumptions of BSM. Assumptions of BSM dash. Number 1, markets are perfect. Thoda fast please. Fast, speed बढ़ाओ. Markets are perfect. Number 2, European options. European options. Number 3, non-dividend paying stock. Non-dividend paying stock. Number 4, ये जो R लिखा हुआ, R is constant. R is constant. Number 5, sigma is constant. Number 6, stock price follows a log normal distribution. Stock price follows a log normal distribution. Stock price follows a log normal distribution. ये जो लास्ट 2 assumptions लिखा है उसको अलग से बॉक्स पे डाल दो. लास्ट 2 assumptions को अलग से बॉक्स पे डाल दो. दिस चैप्टर इज टॉकिंग अबाउट दीज 2 assumptions. ठीक है. दिस चैप्टर नंबर 17 is questioning these 2 assumptions. You can write that word please. This chapter is questioning these 2 assumptions. This chapter is questioning these 2 assumptions. This chapter is questioning these 2 assumptions. Questioning these 2 assumptions. Full stop. Okay. Now, what they have done, now I am coming to the chapter. What they have done is that they took 3-month call option on Nifty, 3-month call options on Nifty at a strike price of 6,000, 6,200, 6,400, 6,600, 6,800, 7,000, 7,200, 7,400, 7,600 and so on. Right now Nifty was at around 6600, 6600. So they took some exercise price below that, they took some strike price above that. They took the option price from the market, they put the option price on the left hand side and they calculate IV. They calculated what? IV. Understood? They took a particular underlying asset Nifty, 3-month maturity, and they took different strike prices and they calculated what? IV. And to their surprise they found that IV is not the same. 6,000 वाले स्ट्राइक प्राइस का आईवी अलग है, 6,200 का आईवी अलग है, 6,400 का आईवी अलग है, 6,600 का अलग है, 7,000 का अलग है, 7,200 का अलग है. जबकि ब्लैक शोल्स का सेकंड लास्ट अजम्पशन क्या है? सिग्मा इज कांस्टेंट. सिग्मा इज कांस्टेंट. सिग्मा किसका सिग्मा है वैसे? इज इट द सिग्मा ऑफ कॉल ऑप्शन और इज इट द सिग्मा ऑफ द अंडरलाइंग? अंडरलाइंग. वी टॉक अबाउट द वॉलेटिलिटी ऑफ निफ्टी. वो तो कांस्टेंट होना चाहिए था, बिकॉज नो मैटर व्हाट स्ट्राइक प्राइस आई एम टेकिंग, वॉलेटिलिटी ऑफ निफ्टी तो सेम ही होना चाहिए था. बट नो, इट इज डिफरेंट. इट इज डिफरेंट. ठीक है? इट इज डिफरेंट, विच मीन्स दैट इट हैज दिस टाइप ऑफ अ ग्राफ. ओके, अभी कॉपी नहीं करना है, अभी कॉपी नहीं करना है. ठीक है? डू नॉट कॉपी प्लीज. सॉरी. एक्स एक्सिस पे के वेरिएबल हो गए, अलग अलग स्ट्राइक प्राइस. प्लीज डू नॉट रिमेंबर लेटर कि एक्स एक्सिस पे एस था, एस नहीं है, के. और वाई एक्सिस पे आईवी. एंड व्हेन दे फाउंड द ग्राफ वाज लाइक दिस. This is a smile or a half smile? Half smile. It is called a smirk. It is called a smirk. S-M-I-R-K, smirk. Half smile. Okay. What you observe over here is that for lower strike price, am I correct? For lower strike price, lower K, IV is what? High. But for higher strike price, higher K, IV is what? Less. Please think of IV, and people do not think, that's why they can't catch the chapter. Please think of IV as option का price. बात हुआ? We are going to talk about option price as dollars or IV? IV. तो मेरा बोलना easy है, तुम मान रहा भी अभी, बट पता नहीं क्यों तुम बाद में नहीं सोचेगा, जिसके कारण आपका टॉपिक का कॉन्सेप्ट आएगा नहीं. IV माने ऑप्शन का प्राइस, IV माने ऑप्शन का प्राइस, एंड द प्राइस ऑफ एनीथिंग इज डिटरमाइंड बाय डिमांड एंड सप्लाई. It is higher demand for lower strike price option because of which IV is high. It is higher demand for lower strike price option that IV is what? High. Higher demand and lower supply, which means I am making it easy. दुनिया में ज़्यादातर लोग lower strike price वाले option को buy करना चाह रहे हैं. There are few people who are wanting to sell lower strike price option. Lower strike price means, tell me, in the money put or out of the money put? Lower strike price means in the money put or out of the money put? That's bad. Out of the money put. You're not understanding. I'm talking about strike price. 90% people while studying the chapter think that I'm talking about share price. I'm not. Share price S है. मैं बात कर रहा था K का. तो K कम है, S ज़्यादा है. S ज़्यादा है, K कम है. तब तो out of the money put. अरे S more than K यार. Call in the money होता है ना. Put तो out of the money होता है. सबको पता है ये चीज. So can I say that deep out of the money put and deep in the money call, deep out of the money put and deep in the money call एक ही बात है. I'm talking about S more than K. K कम है. Deep out of the money put and deep in the money call are priced aggressively. They have a higher IV. While deep in the money put and deep out of the money call have lower IV. Nobody is buying them. People are writing them. प्रॉब्लम ये है, समझने के बावजूद भी अगर लैंग्वेज नहीं पकड़ पाया तो समझा हुआ का राइट नहीं हो पाएगा ना. यू मे फील बैड दैट आई एम ट्राइंग टू स्ट्रेस ऑन दिस लैंग्वेज, बट अल्टीमेटली एग्जाम में तो लैंग्वेज ओरिएंटेड आएगा. तो इवन इफ यू हैव द नॉलेज यू कांट डू इट राइट. ही विल नॉट आस्क यू द वे इट इज टू बी आस्क्ड. ठीक है. तो फिर से बोल रहा हूं, लोअर के का मतलब डीप आउट ऑफ द मनी पुट. ये बैठ नहीं पा रहे तुम लोग के. लेट्स गो टू बुकिश डेफिनेशन. पुट ऑप्शन का मतलब राइट टू सेल. पुट ऑप्शन का मतलब राइट टू सेल. राइट टू सेल एट अ हायर के इज मोर अट्रैक्टिव. राइट टू सेल एट अ लोअर के इज लेस अट्रैक्टिव. वही तो आउट ऑफ द मनी पुट है. कॉल ऑप्शन राइट टू बाय. राइट टू बाय एट अ लोअर के मोर अट्रैक्टिव. डीप इन द मनी कॉल. इज इट ओके? So deep out of the money put, deep in the money call are priced aggressively. They are priced higher. Their IV is what? High. While deep in the money put and out of the money call are priced what? Lower. एक चीज क्लियर कर दूं. Higher, lower over here. डॉलर टर्म से मत सोचना. Am I trying to say कि जो आउट ऑफ द मनी पुट है उसका दाम होगा $70 और इन द मनी पुट का दाम होगा $2? एकदम ही नहीं. ठीक समझ रहे? क्या पता क्या समझ रहा हो. मैंने बोला डीप आउट ऑफ द मनी पुट का प्राइस हायर, डीप इन द मनी पुट का प्राइस लोअर. ये तो लैंग्वेज ही अनडाइजेस्टेबल है. इन द मनी का दाम तो ज्यादा होता है, उसमें तो इंट्रिंसिक वैल्यू होता है. लेट मी टेक फिगर्स. राइट साइड में जो ग्रीन से लिखा हुआ है वो एक्सरसाइज प्राइस है $500 और अभी शेयर प्राइस चल रहा है $300. तो पुट का इंट्रिंसिक वैल्यू 200 हो गया. और जबकि अगर स्ट्राइक प्राइस है $100 और $300 शेयर का दाम है, उस पुट का तो इंट्रिंसिक वैल्यू 0. उसका तो जरा सा दाम होगा. मैं थोड़ी बोल रहा हूं कि 100 स्ट्राइक प्राइस वाले पुट का दाम 500 स्ट्राइक प्राइस वाले पुट के दाम से ज्यादा होगा. एकदम ही नहीं बोला मैंने तो आईवी का बात किया. प्राइस इन टर्म्स ऑफ व्हाट? आईवी. प्राइस इन टर्म्स ऑफ आईवी बोल रहा हूं. ठीक है. तो ब्लैक शोल्स तो बोला था सर जो भी आप स्ट्राइक प्राइस ले लीजिए सबका आईवी क्या रहेगा, सेम, से 22%। बट जब चेक कर रहे हैं तो पता नहीं, दिख रहा है कि जो लोअर स्ट्राइक प्राइस है उस वाले का आईवी क्या है, ज्यादा, और जो हायर स्ट्राइक प्राइस है उस वाले का आईवी क्या है, कम। ठीक है, इसका रीजन एक ही हो सकता है कि एक मिनट, जहां ब्लू साइड है, ब्लू जो है वो ब्लू साइड में एक स्ट्राइक प्राइस इमेजिन करो $100, क्या $100, प्लीज इमेजिन करो, एंड शेयर प्राइस चल रहा है $300, 3 मंथ्स बाकी है, 3 मंथ्स बाकी है। तो इन दैट केस देयर इज अ वेरी हाई प्रोबेबिलिटी और वेरी लो प्रोबेबिलिटी दैट द पुट विल लैंड इन द मनी। आई रिपीट द फिगर्स, स्ट्राइक प्राइस है पुट का $100, स्टॉक प्राइस चल रहा है $300 एंड 3 मंथ्स आर लेफ्ट। What is the probability that in 3 months time put will be in the money? Put will be in the money मतलब in 3 months time the share price will crash and cross 100 on the downside and the put will be in the money. इसका probability is high or low? अरे low ना। Practically speaking 300 का स्टॉक 3 महीने में 200 रुपया गिर जाएगा, 100 को तोड़ के नीचे चल जाएगा, इसका चांस तो लो ही है यार। Absurd fall in stock price थोड़ी होता है। The probability of extreme movements, even if you take log normal distribution. How did you say it high? I meant, even if we are taking the log normal distribution, sorry. This is the log normal distribution. So in the tails, area is obviously low, na? In the tails, area is low as compared to the body. So the probability, suppose this is 200, one second. This is 200, or this is suppose 100, sorry. This is suppose 100. So the probability that the stock price will go below 100 is this, na? Is less, na? Obviously. Okay, is less. However, if this probability as per log normal distribution is 2%, what percent? 2%. But if you look at the price at which the option is trading, the price of the 100 strike price option, then the price implies that, sir, according to the world, the probability that the price will go below 100 is greater than 2%. The option price which is running in the market, which implies an IV of whatever 28%, means that according to the world, the probability that the stock price will go below 100 is more than the probability implied by the log normal distribution. If the log normal distribution is saying 2%, the world is believing that नहीं, मेरे ख्याल से 2% से ज़्यादा chance है. It's 2.5%, it's 3%. तो लोगों के मन में स्टॉक प्राइस गिरने का चांस ज्यादा है as compared to the chance implied by the log normal distribution, the assumption under Black-Scholes, which means the left tail is fatter. The left tail is fatter. The left tail is fatter than what log normal distribution implies. This is the red graph. The red graph is the actual graph that is prevailing in the world for the distribution of stock price, while the black graph is the log normal distribution assumed by Black-Scholes. So on the left side you find the tails are what? Fatter. People are believing that the stock price can go down. Uska probability is higher than what is implied by the log normal distribution. Reason? Everything has a reason. There are two reasons cited by Black-Scholes for it. Sorry, the two reasons cited by the author, Hull. One is crashophobia. What reason? Crashophobia. There was a stock market crash in the US in October 1987. Stock market crash in US in October 1987, just as we in India remember some Black Mondays, na? In the Indian markets. That way, October 1987 was a Black Monday for the US, where the stock markets plummeted by around 15-20%. Okay, and it was found that prior to October 1987, when people used to calculate the IV of options, the IV graph used to be flat. Used to be flat. That is what Black-Scholes says. So no matter what the strike price be, IV should be what? Same. There was no smirk. But after October 1987, God knows what has happened. Okay, after October 1987, the IV ka graph has become like this, half smile, which means there is a sudden increase, upsurge in the demand for out of the money puts. Sudden increase in the demand for out of the money puts. Now who buys out of the money puts? Everybody, all the financial institutions, all the mutual funds, all the banks, they are long on equity. What are they? Long on equity, diversified portfolio. They are all exposed to the systematic risk of market crashing. So they tend to buy put options of lower strike price as a protective put. What? Protective put. They tend to buy as a hedge, as an insurance, क्या यार लग जाएगा, इतना डॉलर लगता है, $2.5 पे कर रहे हैं एक फालतू पुट ऑप्शन का, जो पता है एक्सरसाइज नहीं होने वाला है, आउटसाइड चांस एक्सरसाइज होने का, तो लोग इतना ज्यादा वो बाई कर लिए कि ब्लैक-शोल्स के अनुसार उसका दाम होना चाहिए था 2.3, पर उसका दाम चल रहा है 2.7, 0.4 ज्यादा. तो जब तुम उसका आईवी निकाल रहे 2.7 से, तो आईवी इज हायर देन द आईवी ऑफ अ हायर स्ट्राइक प्राइस ऑप्शन, which means the probability of the world regarding the market crashing is higher than the probability implied by the log normal distribution. Crashophobia, phobia against crash. And why is it that money call are more in demand? Deep out the money put का मैंने explanation दे दिया कि सर लोग उल्टा पुल्टा पुट बाई करके रखते हैं बिकॉज बचने के लिए, पर डीप इन द मनी कॉल लोग क्यों बाई करते हैं? कॉस्ट कैसे कम होगा? डीप इन द मनी कॉल बाई करने का कोई लॉजिक आ रहा नहीं. उसका लॉजिक क्या दिया गया सुनना, लेवरेज. क्या? लेवरेज, विच मीन्स लिसन केयरफुली, when the share price falls, the market value of equity falls. If the share price falls, market value of equity what? Falls. If the market value of equity falls, market value debt equity ratio rises. Market value debt equity ratio rises. Debt divided by falling equity, market value debt equity rises, the company becomes more levered. The company becomes more levered. More levered means more risky. More risky means more volatility. More volatility. That is one explanation given in Hull regarding why IV is high for lower strike price. I was not very satisfied with it, but obviously we are responsible whether you are satisfied or not. वो reason दिया leverage का, share price falls, market value of equity falls. If equity falls, debt equity ratio what rises? Leverage rises, risk rises, volatility rises. But I wanted a trader का reason. क्या reason? I wanted a trading का reason कि why people are buying deep in the money call. Deep in the money call क्यों buy कर रहे हैं? उसके लिए I revert back to what I said 10 minutes earlier. Remember, these people were not understanding delta. Okay, they are CFA L1 students. They were not understanding delta, so I was finding it hard. So how I explained them, I just repeat कर रहा हूँ. We buy a share, we are bullish. We buy a call option, we are what? Bullish. But is one call equivalent to one share? No. So I said perhaps 0.4 share. Perhaps 0.4 share. Now what happens is that if you are buying deep in the money call, deep in the money call, it is almost equivalent to a share. Deep in the money call is almost equivalent to a share. Think about it. When 300 is the share price right now, 100 is the strike price. 100 वाला call option buy कर रहे हैं, वो तो almost share ही है. वो तो exercise होगा ही ना. Share का दाम 300 चल रहा है. तो don't you agree that call option is a better substitute of share when we are talking about deep in the money call? Deep in the money call is, तुम बोलेगा sir, it's almost 90% share, 0.9s. 0.92s. Okay, at the money call 0.5 शेयर होते हैं. Okay, और out of the money call 0.2 या 0.1 शेयर होते हैं डेल्टा उसका. और deep in the money call is almost a share. So I am trying to say that people in the world treat deep in the money call like a share, but still, whose price would be lower? Share price or call price? Call price. How can call price exceed the share price? Never ever. Call price कभी share price से ज़्यादा नहीं हो सकता है. तो इसका मतलब मैं सर शेयर बाई करूंगा, मेरे को पूरा दाम देना पड़ेगा. मैं कॉल बाई करूंगा जो ऑलमोस्ट लाइक अ शेयर है, जो ऑलमोस्ट लाइक अ शेयर और उसका कमती दाम देना पड़ेगा, तो मैं तो कॉल ही बाई करूंगा ना। शेयर बाई करने के बाद चलिए कॉल बाई कर लेते, पैसा कमती लगेगा। तो आई एम ट्राइंग टू से डीप इन द मनी कॉल्स आर अट्रैक्टिव टू पीपल एज अ सब्सटीट्यूट ऑफ व्हाट, शेयर, बिकॉज कॉल प्रोवाइड्स लेवरेज। कॉल प्रोवाइड्स लेवरेज। लेवरेज का मतलब क्या होता है फाइनेंस में? लेवरेज का मतलब होता है कमती पैसा लगा के ज्यादा एक्सपोजर, कमती पैसा लगा के ज्यादा एक्सपोजर। तो कॉल में कमती पैसा लगाने पर एक्सपोजर शेयर का मिल रहा है। दिस रीजन इज नॉट रिटन इन हल. The reason written in Hull is also leverage word, but he has used leverage in the other sense, which I explained उसके पहले. ठीक है? तो just as a sharing device, I tend to appreciate it this way. ठीक है? कि deep in the money call is like a share and it provides leverage. So I like to buy deep in the money call instead of buying what? Share. So high demand for deep in the money call, so therefore the price is what? Higher as compared to the price that should have been via the log normal distribution. And therefore the IV is what? Higher. Okay? So crashophobia and leverage, these are the two reasons given for volatility what? Smirk. Volatility, smirk. Okay? We will go to the slides later, as I always do. I'll complete it. I think I've completed. जब तब जाके slides पे जो लिखा हुआ दिखाएंगे. Okay? वैसे just to disclose, इसका slides मैंने ज़्यादा elaborate नहीं किया है. Okay? I have taken the slides from Hull itself. Hull का slides. So the write-up is less. Okay, but the points are covered, and wherever points are not covered, I will fill up the slides individually on the pages to ensure that the points are covered. ठीक है तो? This is volatility smirk. Volatility what? Smirk. Volatility smirk means lower strike price पे IV is what? High. Higher strike price पे IV is what? Low. उसका language means, it means that deep out the money put and deep in the money call are more costly, are more pricey, not in terms of dollar, in terms of IV. ठीक है तो? And deep in the money put and deep out the money call are less costly in terms of what? IV. Of course, deep in the money put is more precious than deep out the money put in terms of dollars. Don't take that. Okay? What is the implication of this? The implication of this is that the empirical distribution of stock price. What distribution? Empirical, you understand the word empirical, observed. The empirical distribution of stock price has a fatter left tail, and a thinner right tail as compared to the log normal distribution. If you didn't understand that, this means that the probability of the stock price falling to extreme levels is higher in the real world, in the minds of people, as compared to the probability implied by the log normal distribution. And the probability of the stock price rising to extreme levels is lower in the minds of people in the real world as compared to the probability implied by the log normal distribution. Is it okay with us? This is what Black-Scholes is this is what this chapter is trying to explain. But the chapter is named as Volatility Smiles. And we talked about volatility smirk. That's because I did it that purposefully, because we are more enchanted with the equity markets. Equity markets Indians को ज़्यादा समझ में आता है. They can relate everything. Crashophobia. It took 1 second for you to pick that up. Out of all the discussion, as soon as I said crashophobia, वो सबसे बेस्ट समझ में आया. हाँ सा phobia होता है crash का. ठीक है तो एक होता है psyche में अपने. तो I knew it was easy to explain, so I played that game. Book में Hull has first of all explained volatility smile. In case of foreign currency options, which options? Foreign currency options में there is a smile, there isn't a smirk. Have we drawn this diagram? तो एक बार roughly draw तो कर लो, slide से बाद में जाएंगे. Draw this diagram. X axis पे K, Y axis पे IV. X axis पे K, Y axis पे IV. ओके जैसा डिमांड कर्व बनाते हैं वैसा कर्व ड्रॉ कर देना. कर्व ड्रॉ कर देना. और प्लीज जो ब्लू से मैंने मार्क किया ठीक से लिख लो. द राइटिंग इज नॉट गुड. लोअर के के नीचे लिखना. लोअर के नीचे मैंने लिखा नहीं, तुम लिखना. डीप आउट द मनी पुट एंड डीप इन द मनी कॉल. लोअर के नीचे डीप आउट द मनी पुट एंड डीप इन द मनी कॉल. डीप आउट द मनी पुट एंड डीप इन द मनी कॉल. और जो ग्रीन से लिखा हुआ है हायर के, जो ग्रीन से लिखा हुआ है मेरा बोर्ड पे, that's higher K, that's deep in the money put, deep in the money put, और डीप आउट ऑफ द मनी कॉल, उनका डिमांड कम है, उनका सप्लाई ज़्यादा है. एनी रीजन आउट ऑफ द मनी कॉल को लोग क्यों बेच रहे हैं? लेट मी सी. एनी रीजन आउट ऑफ द मनी कॉल को लोग क्यों बेच रहे हैं? एज अ ट्रेडर आई कैन लुक एट द रीजन. कवर्ड कॉल राइटिंग, कवर्ड कॉल राइटिंग याद है, एस प्लस सी माइनस. तो जो भी स्टॉक होल्ड करता है वो अल्टीमेटली ऊपर के दाम पे क्या करता है? सी माइनस. तो ऊपर के स्ट्राइक प्राइस पे इतना सी माइनस हो रहा है कि अल्टीमेटली कॉल का प्राइस क्या है? कम, और आईवी क्या आ रहा है? कम.